Good day, guys. Good day. How are you doing? Hope you're good. So we just decided to read the Candlestick Trading Bible together. Maybe something which you might have missed when you read it by yourself will actually reveal itself when we go through it. So I'm not sure how long it's going to take us to go through the book, but I'll just see how long we can push the sessions, like how many pages we can push per session. So I hope this book helps you as well if you're not yet profitable. It's actually a best book to read, one of the best trading books I've read. So we're going to go through it together. This is just the cover, Candlestick Trading Bible. You can pardon me on some of the pronunciations as well. You can excuse my English. So Candlestick Trading Bible, invented by Isa Homer, most successful trader in history. Okay, so we got the contents page, right? Won't read those. Candlestick patterns. What is a candlestick? History of candlesticks. Right. So the good thing is the book just explains everything. So I don't have to start explaining or doing other things. So what we'll simply do is some of the most important points, I'll highlight them. So that maybe if you missed it, maybe it will make of great future use to you when I highlight it. So here's the introduction. The Candlestick Trading Bible is one of the most powerful trading systems in history. It was invented by Homer Isa, the father of candlestick chart patterns. This trader is considered to be the most successful trader in history. He was known as the god of markets in his days. His discovery made him more than 10 billion in today's dollars. So that's actually a great deal of money. $10 billion there. You can already see the motivation there. Like 10 billion, that's a lot of zeros. Right. I've spent 10 years compiling, testing, organizing, consistently updating this method to create my own new version, which is considered to be the easiest, most profitable trading system. So basically what I'm reading is the author's words, right? These are not my words. As you can see, we're just reading the book together. Okay, is the trading, okay, where are we? The candlestick trading Bible is the trading method that is going to finally take you trading to where it should be: consistent, profitable, easy, and requiring very little time and effort. This trading system is based on Japanese candlestick patterns in combination with technical analysis. All what you have to do is spend as much time as you can to master the method that I'm going to share with you and use it to trade any financial market. Learning Japanese candlestick is like learning a new language. Imagine you've got a book which is written in a foreign language. You look at the pages, but you get nothing from what is written. The same when it comes to financial market. If you don't know how to read Japanese candlesticks, you will never be able to trade the market. Japanese candles are the language of financial markets. If you get the skill of reading charts, you understand what the market is telling you and you'll be able to make the right decision in the right time. Okay, the easy to follow strategies detailed in this work will provide you with profit-making techniques that can be quickly learned. More importantly, learning the principles of the market psychology underlying the candlestick methodology will change your overall trading site forever. The Candlestick Trading Bible has already proven itself. Fortunes have been made using the Japanese candlestick strategies. I congratulate you in taking the first step in your trading education. You're on the right path to become a better trader. However, this is actually the beginning of your trading career. After finishing this ebook, the real work begins. Don't read this ebook very fast. This is not a novel. You should take your time to understand all the concepts I discussed. Take your notes and go back from time to time to review the strategies I shared with you. Remember, this is an educational work that will teach you professional methods on how to make money trading financial markets. If you got the skills that I shared with you here, it will change completely your life and the life of people around you. Okay. Let me just highlight Okay, this part here, you should take your time to understand all the concepts as discussed in the book. Take your notes, go back from time to time, review the strategies I shared with you. So from this point highlighted, what this guy is just trying to say is, you know, with every book, like especially things to do with strategies, you need to keep revisiting them time to time. Each time you read something, something reveals itself which you didn't grasp the last time you read the book. So you have to keep revisiting the book from time to time and just compare, back test. As they say, practice makes perfect. Then if you got skills that are shared with you here, you will change completely your life and the life of the people around you. That's the power of trading. Once you grasp it, the skill is forever. You know, situations might knock you down, you might fall, you might lose money, you might blow an account, but after all has been said and done, skill is skill. You can bounce back from anything, you can make money, and you can take care of your family and your loved ones. Okay, overview. This ebook is divided into the following sections. Candlestick anatomy. Just as humans, candles have different body sizes, and when it comes to trading, it's important to check out the bodies of candlesticks and understand the psychology behind it. That's what you will learn in this section. So that's the candlestick anatomy. Candlestick patterns. Candlestick patterns are an integral part of technical analysis. Candlestick patterns emerge because human actions and reactions are patterned and constantly repeated. In this section, you will learn how to recognize the most important candlestick patterns, the psychology behind its formation, and what do they indicate when they form in the market. Okay, so it's candlesticks anatomy, candlestick patterns, then market structure. In this section, you learn how to identify trending markets, ranging markets, and choppy markets. You learn how these markets move and how to trade them professionally. You also learn how to draw support and resistance and trend lines. Time frames and top-down analysis. Multi-time frame analysis is very important for you as a price action trader. In this section, you learn how to analyze the market using the top-down analysis approach, trading strategies and tactics. In this section, you learn how to trade the market using 4 price action strategies. So we've got the pin bar, the engulfing bar, the inside bar, false breakout, trading examples. I highly recommend you master the previous sections before jumping to the section, because if you don't master the basics, you will not be able to use these strategies as effective as it would be. In this section, you will learn how to identify high probability setups in the market and how to use those candlestick patterns in trending markets and ranging markets to maximize your profit. Then there's money management. In this section, you learn how to create a money management and risk control plan that will allow you to protect your trading capital and become consistently profitable. Okay, history of candlesticks. I think we're on page 8. Okay, history of candlesticks. Candlesticks have been around a lot longer than anything similar in the Western world. The Japanese were looking at charts as far back as the 17th century. Whereas the earliest known charts in the US appeared in the late 19th century. Rice tradings had been established in Japan in 1654, with gold, silver, and rapeseed oil following soon after. Rice markets dominated Japan at this time, and commodity became, it seems, more important than hard currency. Munaisa Honma, aka Sukyu Honma, a Japanese rice trader, born in the early 1700s, is widely credited as being one of the early exponents of trading price action. He understood basic supply and demand, dynamics, but also identified the fact that emotion played a part in the setting of price. He wanted to track the emotion of the market players, and this work became the basis of candlestick analysis. He was extremely well respected to the point of being promoted to samurai status. The Japanese did an extremely good job of keeping candlesticks quiet from the Western world right up until the 1980s, when suddenly there was a large cross-pollination of banks, financial institutions around the world. This is when Westerners suddenly got wind of this mystical charts. Obviously, this was also about the time that charting in general suddenly became a lot easier due to the widespread use of the PC. In the late 1980s, several Western analysts became interested in candlesticks. In the UK, Michael Finney, who was then head of the TA in London for Sumitomo, began using candlesticks in his daily work and started introducing the ideas to London professionals. In December 1989 edition of Futures magazine, Steve Nason, who was a technical analyst at Merrill Lynch in New York, produced a paper that showed a series of candlestick patterns explained their predictive powers. He went on to write a book on the subject, and a fine book it is too. Thank you, Messrs. Finney and Nason. Since then, candlesticks have gained in popularity by the year, and these days they seem to be the standard template that most analysts work from. Why candlesticks are important to your trading analysis? Candlesticks are important to your trading analysis because it is considered a visual representation of what's going on in the markets. So just to highlight that as well, that's why we mainly look at candlesticks as a confirmation or a signal to a setup which we'll be seeing. So candlesticks are important to you in trading analysis because it is considered as a visual representation of what is going on in the market. By looking at a candlestick, we can get valuable information about open, high, low, and the close of the price, which will give us an idea of the price movement. Okay, just a moment. Sorry about that. Okay, candlesticks are flexible. They can be used alone or in combination with technical analysis tools such as moving averages and momentum oscillators. They can be used also with methods such as the Dow theory or the Elliott wave theory. So basically what's being mentioned here is like different trading strategies like the Elliott wave, Dow theory, momentum oscillators. These are indicators. Moving averages, we use some of these moving averages. We'll explain them in later topics. I personally use candlesticks with the support and resistance, trend lines, and other technical tools that you discover in the next chapters. Okay, the human behavior in relation to money is always dominated by fear, greed, hope, and candlestick analysis will help you understand these changing psychological factors by showing us how buyers and sellers interact with each other. Candlesticks provide more valuable information than bar charts. Using them is a win-win situation because you can get all the trading signal that bar chart generates with the added clarity and the additional signals generated by candlesticks. So candlesticks are used by most professional traders, banks, hedge funds. These guys trade millions of dollars every day. They can move the market whenever they want. They can take your money easily if you don't understand the game. Even if you can trade $100,000 trading accounts, you can move the market. You can't control what is going on in the market. So using candlestick trading patterns will help you understand what the big boys are doing and will show you when to enter, when to exit, and when to stay away from the market. What is a candlestick? Japanese candlesticks are formed when using open, high, low, and close of the chosen time frame. Right. So basically, this is a candlestick, right? Let's grab a pen. So the good thing about going through this book is basically good even for beginners because everything is explained from basics to intermediate to professional. And where I can give examples to my better understanding, I will show examples as well on the charts as shown and illustrated in the book. We'll simply go to the charts and we'll try to look for what the book is showing us. So, right, in the book, I think this is a buy candle, the white one, and the sell candle is this red one. Okay, so on my charts, you will notice that the buy candles will be green, the sell ones will be black. Okay. All right, so this is the upper shadow, real body close, high, open. So if price opens, right, And by the time it closes, it's above the open price. It means the color of the candle first is green, or in this instance, white. Okay, then the toppest tip is the high price. This will be the close price. And if it happens to push lower at some point, you should know that it was red at some point, but then it came back up above the open price and it turned green. Then this was the low price and that was the open price. So that's just like an illustration. So the opposite is said for a sell candle, right? This is a buy candle. Let me see if I can switch to a chart. Let's see if the close is above the open. You say that the candlestick is bullish. Okay, it's just the same thing I explained just now. So let's just read to get a better explanation. If the close is above the open, we can see that the candlestick is bullish, which means that the market is rising in this period of time. Bullish candles are always displayed as white candlesticks. So it can be white, it can be green, it can be blue. It just depends with your color, really, with your preference, right? Most trading platforms use white color to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. The most important is the open price and the close price. If the close is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks, but this is not a rule. You can find different colors to use to differentiate between bullish and bearish candles. And the filled part of the candlestick is called the real body. The thin lines poking above are called shadows. They're called shadows or wicks, right? If a candle is like this, that's the body. And these items, they are called shadows or wicks. Okay. The top of the upper shadow is the high, the bottom of the lower shadow is the low. All right. So let me just explain and show you how quickly how a candle opens and closes and how it changes color. So to see that, we're going to go to a 1 minute time frame. Right. So let's wait for the next candle to open so that I explain it. Okay, we're waiting for the current one to close. Right. This is our current price on the right. This is the time on the bottom. Okay, let's patiently wait. Soon as it opened, it dropped. So you saw it was black. If it comes up at any point, it will be green. Right, there we go. And if they come back below the open price, they will be red. That's basically how a candlestick is formed. Okay, see, they come back below, they turn red. Now the high price is the wick above, right there. This is the low price. So let's see by the time it closes where we are going to be. That's all open. Right, if we close below, we'll close being black. Okay, let's see. Okay, the next candle opens. So same thing, that's the open price. If price comes above the open price, this candle will turn green. If they remain below, it will remain black. So if it's black, it simply means that right here on this minute, sell momentum, sell, and currently price is selling, as you can see, right? So I hope that makes it clear for the beginners on how these candles are formed. So let's just do one more example. Let's see how this one closes. Remember, this is the open price right there. Now we are above, so we are green. You see it's green. If we come back below, it's going to be black. So this was the open price of the candle. There we go. We close here. Price opens here. As soon as they open, we are red. If they go up, we're going to be green. So basically, that's the anatomy on candlestick formation. How each candlestick, what it means, we're going to get to it later. So I'll try not to confuse the beginners by mentioning other things. I'll just open a chart and quickly mention what we were reading about. Then I'll quickly go back to the book. Okay, let's go. Candlestick body sizes. Candlesticks have different body sizes, right? There's the long versus the short, as you can see. Long bodies refer to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during this period of time. Okay, so a quick example is just on the candlesticks which what we're opening just now when we're looking at the charts. The one which was opening, coming down a little bit and being black, then it goes up, right? Goes high a bit, but then closes here. So it's green. If it's green and it's huge, it simply means here there's a huge buying momentum, right? The opposite is true for sales. Here there's a huge selling momentum. Here there is less action. Here there is less action. All right. So let's read and see what all that means. Okay, conversely, if there's a bearish candle in which the open is above the close with a long body, this means that the selling pressure controls the market during this chosen time frame. Short and small bodies indicate a little buying or selling activity. Candlestick shadows or tails or wicks, right? Remember those wicks I mentioned. It's either it's wicks, tails. Okay, shadows, tails, or wicks. These items on a candle, these protruding items, those are your wicks or your tails, right? The upper and lower shadow gives us important information about the trading session. Upper shadows signify the session high. Lower shadows signify the session low. The candlesticks with long shadows show that trading action occurred well past the open and the close. Okay, long shadows. Okay, long upper shadow, long lower shadow. Japanese candles with short shadows indicate that most of the trading session was confined near the open and close price. If a candlestick has got a longer upper shadow and the short lower shadow, this means that the buyers flex their muscles and beat price higher. But for one reason or another, sellers came in and drove price back down to end the session back near its open price. If a candlestick has a long lower shadow and a short upper shadow, this means that the sellers flush their washboard ebbs and force price lower. But for one reason or another, buyers came in and drove prices back up to end the session back near its open price. Okay, candlestick patterns. Candlestick patterns are one of the most important, powerful trading concepts. They are simple, easy to identify, and very profitable setups. And research has confirmed that candlestick patterns have a high predictive value that can produce positive results. I personally trade candlestick patterns for more than 20 years. I can't really switch to another method because I tried thousands of strategies and trading methods with no results. I'm not going to introduce you to a holy grail this trading system works, but be prepared to lose some trades. Losing is part of this game. If you are looking for a 100% winning system, I highly recommend you stop trading and go look for another business. So before you get well to invest in trading, you should also know if you're a beginner, losses are just part of the daily business. Okay, losses happen always. You can have a loss, 2 losses, 3 losses in a row. You can have a losing week. You can have a losing month. You can have a bad losing streak, but the trick is just to make sure that your losses are small. So that will be touched in future topics when we talk on risk management. So let's continue. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you don't speak the. Why am I feeling like we read this before? Let's see what page 30. This is 13. Okay, let's see. Okay, let's see. I don't know what happened to the book. Did it skip pages or what happened? Or we are on track and it's me who was confused. Anyways, let's just continue. Candlestick patterns are the language of the markets. Imagine you are living in a foreign country and you don't speak the language. How could you live even if you can't say word? It's tough, right? The same thing when it comes to trading. If you know how to read candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamics and the trader's behavior. This skill will help you to better enter and exit the market at the right time. So this is the importance of knowing candles, right? It will help you mainly on entries. So you want to see how your candles will be closing on the particular time frame you'll be trading on. As a way to enter, as a way to manage your trade, as a way to exit. In other ways, this will help you act differently in the market and make money following the smart guy's footprints. The candlestick patterns that I'm going to show you here are the most important patterns that you'll find in the market in this chapter. I'm not going to show you how to trade them because this will be explained in details in the next chapters. What I want you to do is to focus on the anatomy of the pattern and the psychology behind its formation. Okay, so that's also an important thing to note. Okay, you need to focus on the anatomy of the pattern and the psychology behind its formation. Candles in certain areas don't mean anything. Candles in certain area mean something. Okay, so this will help you get the skill. Okay, what did I do here? This will help you get the skill of identifying easily the pattern you find in the market and understand what it tells you to do next. Okay, if you get this skill, you will be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapters. Okay. 15, okay, page 16. The first candle we're going to talk about, the engulfing bar candlestick. Engulfing bar candlestick, right? So let's mark that as well. Okay, the engulfing bar candlestick pattern. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than one previous candle, but we considered an engulfing bar, at least one candle must be fully consumed. The bearish engulfing is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. See the illustration below. Okay, so you get a smaller body, you get a bigger body, and the bigger body is just covering the smaller one entirely. So if it's black for sells, it means it's bearish. Right? A bear, sell, short. This means the same thing. This means down. Then we've got bull, buy, long. That stands for buys. So if somebody says bearish, sell, short, I'm going short on something, something is bearish, it just means it's going down. Something is bullish, buying, or long, it just means it's going up. Okay. So bearish engulfing, it means it's going down. So there's more selling momentum right there. Okay, let's see what the book says. This is how a bearish engulfing pattern looks like on your charts. This candlestick pattern gives us valuable information about bulls and bears in the market. In case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that the buyers are engulfed by sellers, which signals a trend reversal. Okay. Okay, just a moment. So electricity. Sorry about that again. In case we're building up engulfing bar, this pattern tells us that sellers are in control of the market. Okay, I wanted to mark. I wanted to highlight. Okay. Okay, how do I do this? I actually want to undo that one. Okay. And there we go. When this pattern occurs at the end of an uptrend, this indicates that the buyers are engulfed by sellers, which signals a trend of reversal. See the example. So now we know what a bearish engulfing candle looks like. Now we look for it in the charts. Right. So in this particular example, if price was pushing up, right, your price is pushing up, buyers are in control. Then for some reason, you see a short candle, you know that price is slowed down, right? Then the next candle comes and it totally covers the small candle. That's a bearish engulfing. It's now signaling that there's now a high probability that this price is now going the other direction. Okay. As you can see, when the price action occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the markets and sellers are trying to push the market to go down. You can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm. Okay. What this simply means is it's not that each time you see a bearish, you should just open a sell. Each time you see a bearish candle, you should open a sell. You have to check if it's lining up with other confluences telling you to sell. It can be an indicator, it can be a support and resistance zone, it can be a moving average. Those are things which we'll look at in the future pages. All right. We will talk about this in detail in the next chapters. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you can find. Okay. So I'll read the bullish engulfing bar pattern part as well. Or before we go there, let's just go quickly to the charts and look at the bearish. So for this, just going to go to a higher time frame. So on your charts, you might be wondering why I'm saying time frames for newbies, those who are new. On these trading platforms where we trade on, there is time frames, right? They range from the 1 minute, right? 2 minutes, 3 minutes, 5 minutes, 6 minutes, 10 minutes, 15 minutes, the 30 minutes, 20 minutes, 1 hour, 45 minutes, depending with the platform. Some platforms offer you different time frames. Some platforms offer you unlimited time frames. So the highest we have on this particular broker is a month. So it means if you're on the monthly chart, each candle represents a month. If you're on the daily chart, each candlestick on the daily chart represents 1 day. If you're on the 4-hour chart, each candlestick on the 4-hour chart represents 4 hours. Right? If you're on the 1-hour chart, each candlestick on the 1-hour chart represents 1 hour. And if you check right here, you'll see those are the time frames. We have monthly, 2 minutes, 10 minute, 2 hour, 3 hour, 12 hour, weekly, daily, 4 hour, 1 hour, M30, M15, M5, M1. Those are the particular time frames I have on this particular broker. And one other thing, everything I'm explaining here, don't mind what asset I'm opening. Everything tradable, any asset tradable. As long as there's indicators, this strategy just works the same. Okay, so we are on the chart. Isn't this perfect? I think we almost have a good example here. Where we're coming up. That's a bearish engulfing here. Why I would consider this one is because this body sort of engulfs the green body, the bodies. These are almost equal. Bottom one passes the green one a bit. So I would consider this a bearish engulfing candle. So if it lines up with something, right, like S&R zone or a resistance zone, indicator somewhere on the bottom there, something lining up, I will execute my sales and my stop loss will be above there. And for this example, you see the price just melted, right? And it was followed through by another bearish engulfing here. So now you should understand, if you are trading with the trend and you get a bearish engulfing, it simply means it's a continuation now. It's just a variation. I think it will be explained when they talk about the bullish engulfing, right? So if you see it at the top, like for example, we can get one here, not necessarily this one. Okay, I will look for it when we're looking at bullish engulfings. This is an example of the reversal. This is an example of the continuation. That's one thing you should just note. So let's see if we can scroll back and get another. Okay, we've got one here. We agree that it's engulfing that one. Okay, so on this particular one, depending with what was lining up, there was no follow through. Okay, so that's why it says do not trade any just any bullish or bearish engulfing candle you see. Wait for confirmations, check for confluences. Okay, we had one here, but check what happened, no follow through. This almost looks like one here, no follow through again. Then we had one more. Then after that, there was a follow through. There's a certain few candlesticks which we'll touch on in the future here. Bearish, price drops, drops, drops. It just melts away, right? So that was after 1, 2, 3 fake outs. So it's 2 fake outs, then execution. So remember, the dealer won't just give you money like that. There will be traps, right? You should also anticipate that when you are trading, there will be traps. So let me not speak much into that. Let's look for another one. There's one there. We can all see it, right? Bearish engulfing. There were sells. There's one here. Then there was sells. Okay, let's scroll again, see if we can get some more. Okay, there's one right on the right-hand side here. But I think by now you understand what a bearish engulfing is. A bullish engulfing is simply the opposite. So let's just quickly go back to the book. Okay, you can't trade any bearish candlestick pattern you find on your chart. You will need other technical tools to confirm, all right? We'll talk about this in details in the next chapter. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you find. You did that. Bullish engulfing bar, the bullish engulfing bar pattern. The bullish engulfing bar consists of 2 candlesticks, and the first one is the small body. The second one is the engulfing one. See the illustration. So it's just the opposite of the bearish, right? You see it there. The bullish engulfing pattern tells us that the market is no longer under control of sellers and the buyers will take control of the market, right? When the bullish engulfing candle forms in the context of an uptrend, it indicates a continuation, all right? So its opposite can be said for a bearish engulfing, like I said, okay? When the bullish engulfing candle forms in context of an uptrend, it indicates a continuation. When a bullish engulfing forms at the end of a downtrend, the reversal is much more powerful as it represents a capitulation bottom. See the example below. Okay. Let's go. Let's check it out. Okay, there we go. So you see now this is basically the opposite. We were coming down. Then we get a nice bullish engulfing there. Price pushes up. And that was some nice buys there. So that's basically what we look for when you open the market, the charts, right? That's what we look for when you open the charts. The example above shows us clearly how the market changes direction after the formation of the bullish engulfing bar pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies is not important. What's important is that the smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price setup alone, because you will need other factors of confluence to decide whether the pattern is worth trading or not. I will talk about this in the next chapter. So like I said, don't just trade each bullish or bearish engulfing pattern you see. You need to see if there's a couple of things lining up for you to execute the trade. So what I want you to do now is to get the skill of identifying the bearish and engulfing bar pattern in your charts. This is the most important step for the moment, right? So I think, guys, today we'll end here. We'll just continue from page 20. So for now, we'll just slide again to the chart and look for the bullish chart, the bullish engulfing candle. Okay, what do we have on the bottom there? Isn't this almost the same like the example in the book? Price was coming down. And then we get this bullish candle here, right? That's the first sign that price is going up. Then from there, they just eventually shifted, went up. Here's another bullish engulfing. This one is showing continuation now because we are already going up, and it engulfs the last candle. It's green. It shows momentum is high. Price just continued pushing up. So these are the things you look for in the markets, right? You look for these type of candles. Right, let's see here we're the bearish, but it didn't mean anything. Another bearish here didn't mean anything. Another bearish here didn't mean anything. So here there was a bit of like a choppy market, which we'll explain in the near future. Right, let's see if we can pick another one. Okay. Here price was coming down. It's more like this is like patterns when you talk of patterns. So I won't talk much into it, but there was one right there. Okay, and there was one right here. Again, we are in an uptrend, right? Price is showing us the passion to push up. Okay. Then that's a bearish engulfing. Price sort of delayed, but eventually dropped. Okay, so I hope for now you just need to take your time and go back through your charts, whatever you trade, back test a bit, scroll and see what you can come up with, understand the candles. So when we resume on our next session, we will start on page 20, right? The doji candlestick pattern. So let me just put this here. All right, so thank you so much, guys. Now is the time for back testing. Go through your charts, open your daily or 4-hour charts and look for those candles. Only look for them on higher time frames. Your 4-hour, your daily, your weekly, your monthly. That's where you look for these candles. So I hope you're enjoying so far. If there's any way you want me maybe to change the way I present or go through the book, you can just let me know, then we can do it for future readings.